Well, one of the things that's adding pressure to the financials is Moody's lowering the credit rating on 10 small and mid-sized U.S. banks yesterday, while warning that some of the bigger ones like U.S. Bancorp, Bank of New York Mellon, Truist could also face downgrades. It's kind of scratching a worry that we thought was in the rear view about the regional banks and their ability to withstand higher rates, a slowdown, the commercial real estate market. But our next guest is a buyer of the sector. Let's bring in Nancy Daoud, CEO and private wealth advisor at Opus Advice. Thank you so much for joining us, Nancy. Talk to us about how you're thinking about financials these days.
Good morning. The financial sector has taken a big beating with the decline and the collapse of SVB and the smaller banks earlier this year. And what happened really was kind of like a complete decline of the entire financial sector unnecessarily, since it was really more about the smaller banks. So we felt that that was quite the opportunity. And it has lagged the broader market. So when the market is doing so well, we always look for the lagging sectors, and financials is certainly one of them.
Now, how does it overcome sort of this huge wall of worry of, exposure to commercial real estate, deposit base that is getting more expensive, a lackluster capital markets, kind of the list goes on and on?
That's true. It's very, very curious how the tightening of the money supply and the rising interest rates still has not shown up in all of those situations that you just mentioned. Ultimately, it probably will, but it really all just depends on whether we're going to have that soft landing or whether we'll actually end in recession or not sometime next year. And there's two schools of thought. One is that we will have that soft landing since there's so many positive things going on, better than expected GDP growth. Consumer spending is very strong. The outlook has somewhat changed to more positive than negative. But on the other hand, we have the U.S. downgrade of the rating from AAA to AA+. And that's not a good sign either. That has happened before in the past, and we did get through it. But it still stands that government spending is 25% of GDP, and that's way more than tax revenue that's coming in.
That's one of those things that people know, but it's kind of hard to, I guess, price in on the daily when you're investing. So it's one of those things that are in our background, things to be worried about, but you're not sure when it's going to show up. How are you putting that into practice? Are you raising cash? Are you looking to diversify your portfolio? Walk us through how we're supposed to put that kind of worry into practice.
Well, my advice to investors is always that time in the market will always beat timing the market. So you could see, today we're basically erasing all of yesterday's gains. And I would expect from day to day, we will have that kind of volatility in the environment that we're in now, given that so many positive things happening, but also extremely negative things happening. So I would expect a pullback since the market has been up so much this year. But for investors, I think that it's really important to remember what are your timeframes for your goals and also your appetite for risk. And we advise clients to break up the assets into now money, later money, and much later money. And the much later money is really your opportunistic stuff. That's the money that you want to just be in it for the longer term and not worry about the day-to-day gyrations. But the now money should really be fairly stable and fixed.
Let's talk about where you might find opportunities for any of those buckets. For the year, the more defensive sectors like healthcare, like utilities, are among the worst performing so far in 2023. But if you look in the past month, healthcare has pulled away to be among the best. We're seeing some all-time highs in drug makers Novo Nordisk as well as Eli Lilly. How are you thinking about the role those defensive sectors should play at this point in the market rally?
Well, like I said earlier, we always, in a market that's this strong and has done so well in the first part of the year, we look for the opportunities, and that would be the sectors that have not done so well than the broader market. And those are healthcare and utilities, as well as financials. So that's where I think that those are the sectors that present opportunities. Utilities will likely do well if the market does have that soft landing, or the economy has the soft landing, or even if it's worse than expected, that should shine. And also healthcare will continue to get stronger over the long term.
Thank you.